Okay, so now we get to our deal decision and deal financial tab. So the purpose of the deal decision tab is the deal decision tab is going to tell you what your max allowable offer on a home is. So to this point, you had already run your ARV, you had already run your rehab scope of work and figured out what the rehab cost will be. So now what we need to figure out is what can we offer on the home? And that essentially is what the left side is going to do. Now on the right side, let me clear out some of these. On the right side, we have a refinance check. Why do we have a refinance check? We're flipping a home. What happens if you don't sell the home? How are you going to go about refinancing out of this short-term high interest loan? The short-term high interest loan, you're going to have 10% interest and the term will be 12 to 18 months. So if you can't sell it and that term's coming due, what do? You'd most likely perform a refinance. So basically what the right side is going to do, it's going to tell you if you can refinance the product. And I can tell you that you should make sure that you can refinance the product. Just worst case scenario. So this will tell you that on the right below. So it'll show you here, and then below it, this will show you if you're going to make money on the refinance or if it's going to cost you money in order to do a refinance. In my opinion, the most important part is that you can refinance. If you can refinance, there's a lot of strategical ways you can go about funding the cost to refinance. But if you can't refinance, that's worst case scenario. So you want to make sure you can refinance. Now, this information is being extracted from our deal financial sheet. So basically, our deal financial sheet is going to give you kind of all the information you'll need to know about the deal. All the yellow, you're going to have to input. The green is just key financials to keep in mind, and all the magenta is going to be a drop down that you'll be required to select an option on. So when you fill out the deal decision, all the yellow will be, all the white would be automatically inputted, but you're going to be required again to do all the yellow. So here are closing costs. Closing costs are typically 2 to 3% of purchase price. Holding costs are typically 1/10%, between 1/10% and 2/10% of the purchase price per month. So if your purchase price is 200,000 and you're doing 1/10% per month and you're holding it for 6 months, so 1/10% of 200,000 is 200. 6 months, that'd be $1,200. That would be your expected holding costs, and these holding costs would be predominantly more so the utility costs. Down here, you're going to enter in the leverage that your lender is going to give you. Every lender is going to be different, so that's why we allow you to kind of manipulate the data. You're going to put what percent of purchase are they covering? What percent of rehab are they covering? How many loan points are they charging? And what annualized interest rates are they charging? So you would go through and you would input that information. You also have in the yellow your admin fees. These are going to be fees that are going to be your hard money lender is going to charge for that aren't otherwise accounted for, including courier fees, legal fees, underwriting fees, all these small fees that they add into the when you secure their loan. This is where you're going to input that information. Now, right over here in the yellow, this is GAAP. This is all based on GAAP. So basically what will happen is the lender is going to provide you, let's say 75% leverage on the total project costs. That's going to leave an amount that you're going to have to cover. Now, it's your decision how much you cover. But let's say that you decided that you're going to cover, 10% of that, and then you're going to raise 90%. If you're going to be raising 90%, you're going to need to offer some sort of return to the investor. You can offer the return to the investor in a couple of different ways. But in fix and flip loans, what's recommended in the most traditional way is you're going to offer interest. So essentially what you're going to be saying is, I'm going to give you, for the longer I hold your money, the more money you're going to make back in interest. And now there's, so you up here, let's, if the second position lender is charging points on the amount that they're lending, you would enter it here. If not, you would enter, you can actually do them, you can do them both. So let's say it's like 1 point plus, let's say it's, you offer a 20% annualized rate. So what that annualized rate means is that if you hold it for 1 year, it'll be 20% interest on their money. If you hold it for 6 months, it'll be half of that. So it'll be 10% interest on their money. But let's say you decide to give fixed. So what does fixed mean? That means that in the same scenario, if you hold it for 12 months, it's 20%. If you hold it for 6 months, it's not 10%, it's still 20%. So you would basically say if it's fixed or not. More traditionally, you're going to offer an annualized rate of return. But if you decide you also want to offer equity, you can offer equity as well. So what you would do is you would come over here and you would say yes or no. So remember that equity is, the equity share is going to be based on the total profit. So the more money, if you make, $100,000 and you're offering, 10%, be, $10,000. If you make $50,000 at 10%, it's going to be $5,000. So that's how equity works differently than interest, which interest is going to be more fixed and it's going to be easier to kind of forecast. But you can still offer equity by turning it on, and then you put your gap equity percentage at whatever it is. So the way this is currently situated, it's going to run both. You're offering debt and equity. If you just were going to offer equity, turn debt to 0%, or if you were just going to offer debt, then turn equity off. And more traditionally, we're giving just debt, interest on the debt at least. Down here, your real estate agent commission. So when you go to sell the home, what percent of the sale price is going to the agents? And there's two agents. There's going to be your agent, their agent that's representing you as a seller, but there's also going to be an agent representing the buyer. Traditionally speaking, you're given 2.5% to the listing agent and 2.5% to the buyer's agent. So we have it here at 5%. Then finally, what are your resale close costs? I put a little note here, typically between 2 to 3%. So we're going to keep it at 2.5. So now coming up here, your deal decision. Basically what you're doing is you're training the system and you're telling them, I need to make this amount of money, or I need to make X percent of this for me to move forward with the deal. So usually speaking, there's two ways you can do this. You can base it on ARV. So this is basically saying, if I sell the home for $200,000, if I sell a home for $200,000, what percent of that do I need to make sure I make in order for the deal to say, yes, it's a good deal? So let's say you need to make 10% of ARV. So if you sell it for $200,000, you need to make $20,000. You sell it for $400,000, you need to make $40,000. You sell it for $600,000, you need to make $60,000. It's a good way to do it. Now, if you're playing within a smaller threshold, let's say you're playing within, $350,000 resale over and over again, and it's a very competitive market, you say, you know what, for every deal within this, within, a 350 ARV, I need to make a minimum of $25,000. So in that scenario, you would take this number and you would change it to minimum profit, and you would enter in your minimum profit. Now, let's get some real life numbers here. So we're going to come over here, we're going to enter it in. How long does it take us to flip? Historically speaking, we're going to use a lower resale price here. It takes us 4.2 months, so I'm going to call it 5 months. I'm going to leave purchase price blank because I'm going to enter in what we already know. We've already figured out that our rehab cost is $60,000. We've already figured out that we can sell the home for $350,000. Okay. Now, what can we offer on the home? Understanding that we have a minimum profit threshold of $25,000. So what we would do for purchase price, we would just start entering numbers in. We cannot, as you see here, nope, we cannot offer 250. We cannot offer 225. Okay, we can offer 210. We can offer 215. We cannot offer 220. Okay, so 215 is the max allowable offer given the way we've structured this whole sheet so far, where we're giving 20% annualized rate of return on the debt, where we need to make a minimum profit of $25,000, understanding that here we have understanding are the leverage we're getting in the first position. Now we come over here for the refinance check. Again, we want to see if we can't sell the home, can we at least perform a refi? So enter in your refi. We had a little bit of a rate cut this past week, so about 5.75. I know we can rent it for $18.50, and the minimum DSCR for this lender is 1.25. So typically, your minimum debt service coverage ratio is going to be between 1.2. It needs to be a minimum of 1.2 to 1.25, but every lender will have different terms in terms of their refi, so you have the ability to kind of manipulate that. Let's say it was 1.3, it's going to say no, but traditionally speaking, it's 1.25. So what this means is that if we can't sell it, we can refi. It's going to cost us a little bit. It's going to cost us about $42K to refi, but we can still refi. So what I like to focus on, ensure that you can at least perform the refi. We can all work together and try and figure out how to help you raise what you need in order to refi. But again, in the worst case scenario, can you at least refi? The answer is yes. Great. Let's come back over here to our deal financials. So you'll see that 215 purchase, 60K rehab, closing costs again between 2 and 3%. So let's say closing costs for 2% of purchase. So we're going to manually input, call it about $4,000. And holding costs, we know they are about 1/10% of the purchase price per month. Let's say it's $215 per month, which would be 1/10% of purchase over 5 months. That would be, what is that? 215 times 5,075. Look what happened. The good deal suddenly went to no. So what we're going to need to do is, once we finish up the admin fee here, call it $1,000, we now have to look at, okay, let's go back over, and 215 doesn't work anymore. How about 210? Okay, now 210 works, and our refi check is still there. Great. So here you see going down the line, you're getting in total of the ARV, you're getting about 57.9% of ARV on the leverage. Your total loan amount in the first position is 202. You're going to be paying about 3,037 in points. So at 1.5%, if that was 1%, that number will go down, as you see. And you are going to be paying an interest over 5 months, $8,859 at 10.5%. Again, if that's 11%, that number is just going to go up. So now you get into your down payment. You're going to be required to put $72,575 down. Your total fees, which are your hard money total fees, which is going to be the points plus the total interest, will be $12,000. And we're going to less that from your contribution. So again, generally speaking, 2 to 5% you're going to contribute of your purchase price. So let's throw in a contribution right there. So the gap loan amount is $79,881. Now, what you're saying is you're going to contribute if there was no contribution, it'd be $84,000, but you are contributing $5,000. So the total gap amount is $79,000. So how are you structuring that to your investors? Again, in this example, we are giving our investors a 20% annualized rate of return on the $79,000. So if we are to, again, hold their money for 5 months, we are going to have to pay what outputs down here, the gap interest, and the gap interest is $6,656.77 at 20%. At 15%, it goes down. At 25%, it'll go up. So you see it working in real time. hypothetically speaking, if you were like, oh, let me see, instead of that, maybe I gave 10% on the debt and maybe we give a little bit in equity. Say I give 10% equity. What it's going to do, it's going to factor that all in. So now basically you are going to have to pay this to them, 10% on the interest. And then when you sell the property, because again, equities from the proceeds of the sale, you're going to have to pay an additional $3,304, which was going to be essentially, 10% of your overall of the overall profits. Um, Again, you can kind of play around with this and see, but I'm going to keep this on for now. You have your agent commissions, etc. So over here now, you see that you are paying $3,328 in interest. You are paying $3,304 in equity, or $6,632 in total profit over 5 months. That means that their total profit is going to be 8.3%, or over 5 months, it's going to be about 19.9% annualized profit. And I always just throw this in for shits and giggles. You're contributing $5,000, but the total profit on the deal is going to be $29,000. So you have a 594%, not 594.7% cash on cash return. So this sheet is awesome. You can really play around with it. You can get creative with it, but I'm going to tell you straight up here, in the second position, you should be raising more times than not on interest, annualized interest, anywhere between 12 and 20%. So that's kind of the going range in the second position that you're going to be offering. And so you can kind of play around with that and the numbers will change. Make sure that your deal still says yes throughout. If you come back into here and now, you give 20%, it still meets that threshold, but let's say 25%. No, if this is the arrangement you had with your investor, you need to go back into here. You cannot make this offer anymore. You got to make it lower. And now we're at yes. So great. So it works. So essentially, this is your deal financial sheet and your deal decision tree. This is going to be one of your best friends in terms of structuring your deals on the investing side, but also in terms of ensuring that you are offering on a home at a number where you can make your minimum threshold.